On average, 1/3 of your life will be spent working. So you might as well learn where portions of your earnings are going. In this video, we'll cover a breakdown of your paycheck to understand exactly what each line item represents. Make sure to stick around until the end of the video as I'll share smart money tips along the way to maximize your paychecks. For this video, I've created a sample paycheck with 6 sections, as you can see here. You'll likely see something similar on your end as well. In starting out with the personal information section, this is where you'll see things like your full name, the company you work for, and any employee ID. Additionally, you'll see your pay period beginning and end. This is basically the time period that you've worked for which you're receiving the paycheck. Another feature of this sample paycheck, and likely the paycheck you see on your end as well, is you'll see current and then YTD. The current piece is really just looking at this paycheck, this current paycheck, whereas YTD stands for year to date. In this area, you can see all the money you've earned throughout the year up to that current point. You can see all the taxes that have been withheld. In the next section, you can see gross pay. This is the amount you've earned before any taxes, benefits, or other payroll deductions. Now, if you're salaried and paid bi-weekly, there's typically 26 pay periods per year. So this gross pay amount will be your salary divided by 26. Alternatively, if you're not salaried and instead paid hourly, you'll see the hours you worked in that pay period times whatever wage you make. Additionally, in this gross pay section, you'll see various bonuses, like a sign-on bonus or annual bonus. As you may have learned the hard way, you don't actually pocket your gross pay. Let's learn more about the various deductions that are taken from your gross pay, resulting in the money that you actually earn. Starting with employee taxes, one major area of employee taxes is called FICA, which stands for Federal Insurance Contributions Act. This is a federal payroll tax that supports both Medicare and Social Security. At this point in time, Social Security provides financial security to Americans after they retire or have certain disabilities. As an employee, you will pay 6.2% of your taxable wages. Taxable wages does not necessarily mean your gross pay, but we'll look at this more later in the video. As of 2023, you'll pay 6.2% up until you reach $160,200 in earnings. The other piece of FICA is Medicare, and Medicare is federal health insurance for Americans older than 65 and some younger people with certain disabilities. For this Medicare tax, you'll pay 1.45% of your taxable wages without any cap. So unlike Social Security, regardless of the amount of money you make, you'll always have to contribute at least 1.45% to this program. Now, some high earners may actually have to pay additional Medicare tax. Once your earnings for the year exceed $200,000, you'll also have to pay an extra 0.9% on all of those wages until the end of the year. On your paycheck, you might not see FICA. Instead, you could see Medicare and OASDI. Medicare is Medicare, and then OASDI stands for Old Age, Survivors, and Disabilities Insurance. This is the same thing as Social Security, so again, it's that 6.2% with the wage base. Next, let's look at federal income tax, or you may see federal withholding. This is usually the biggest chunk taken from your paycheck. This federal tax is collected by the IRS to support national programs like defense and national security. The amount of federal income tax you pay is based on a variety of factors, including your gross income, your tax situation on your W-4 form, and other factors like the number of dependents you have. You usually fill out your W-4 when you're first hired at a new company. Since there's a lot of variability within people's responses on their W-4s, including how dependents give you tax breaks and things like that, there's really not a flat percentage that everyone gets charged. Some people believe that not claiming any extra deductions, for example, a dependent, on your W-4 is a good idea because you'll get a larger tax return at the end of tax season. Throughout the year on every single one of your paychecks, you'll actually be paid less money. Then at the end of the year, you will get that lump sum tax return, which some people like, but you can also think of it as you giving the government an interest-free loan for the entire year. Many tax experts do not suggest doing this. Instead, you can maximize your paycheck every month by taking those tax breaks in real time, then taking any extra money you earn and putting it into investments or a high-yield savings account. In order to make sure that your W-4 and paychecks have the correct deductions, I recommend meeting with your HR department. Aside from the inputs on your W-4 form, you can actually lower the federal taxes you pay through 401k contributions, which we'll cover in the next section. Next, let's look at state taxes. These cover taxes owed to your state governments. You'll want to do further research on the specific state you live in or work in to understand what you owe. There are different nuances in tax laws for if you live in one state and then work in another. So again, highly recommend doing some personal research or meeting with a tax professional. Our next section is pre-tax deductions, but before diving in, make sure to leave a like and subscribe if you're enjoying things so far. Pre-tax deductions are money taken from your gross pay before any taxes are withheld on your paycheck. These deductions reduce your taxable wage or income, meaning you'll owe less income tax. Firstly, we can look at commuter benefits. If you commute to work and this benefit is available, I highly recommend signing up. This means if you take the train, the bus, the subway, or even park at your office, you can use this pre-tax program to buy various tickets or passes throughout the month to use to commute to work. The idea is that you'll save money through these pre-tax programs, and whatever amount you pay is subtracted from your gross pay and reduces your taxable wage. This taxable wage is then used to determine how much you owe in things like Medicare or Social Security, along with your federal withholdings. Next up, we have HSAs or health savings accounts. These payroll deductions are added into your HSA account, which can be used in the future to pay for qualified medical expenses. Similar to the commuter benefit, your HSA contributions limit your taxable income. The next pre-tax deduction we have is your insurance premiums. For these, you can think of dental, medical, or vision insurance. The premium is the amount you pay on every paycheck or every single month for these different insurance benefits. Once again, these deductions lower your taxable income and also, of course, offer health benefits. Now, when looking at retirement, an excellent way to prepare for your retirement is to make contributions directly from your paycheck. In looking at pre-tax, you can think of your 401k, 403b, or 457 plans. Now, these contributions will be taken from your paycheck and flow directly into your investment account, whether it's with Vanguard or Fidelity. And then you can invest into various mutual funds or ETFs, bonds. One thing to note is that these retirement contributions do lower your federal taxable income, but the reductions are not recognized for what you owe for FICA. After starting with your gross pay, removing employee taxes and pre-tax deductions, finally, the final withholdings are post-tax. And this is where the retirement contributions through Roth accounts come in. These are accounts like a Roth 401k or 403b. And as mentioned, the money you put into these accounts are after tax. The benefit is once you retire and want to dive into these investment accounts and use the money, withdrawing it is tax-free. Oftentimes, employers will contribute a match to whatever you contribute to your retirement account. This also applies to pre-tax retirement contributions. Every company will have a different match program, but your company might say it matches every dollar up to your first 5% of eligible contributions. What this means is if you make $5,000 a month and contribute 5% yourself, or $250, your employer will also match that 5% by contributing its own $250. This is a great benefit if available. It's essentially free money into your retirement account. Other items you may see on your paycheck within this post-tax deduction section are 529 contributions, child support, and different money you pay to charities. So you've made it all the way from gross pay through the various payroll deductions. Now we can look at arguably the best piece of your paycheck. This is known as net pay. This is the amount of money you actually earn into your bank account after all of these various deductions. Now you know what makes up your paycheck from gross pay all the way down to net pay. As mentioned, I recommend meeting with your HR department to make sure that you're being paid the correct amount. Thanks for watching. Leave a like and subscribe if you enjoyed, and also check out this video.